Many analysts believe that the largest New York banks are trading at sufficient discounts for investors to see plenty of upside during 2012. The following four New York banks all trade at significant discounts to tangible book value, according to S&L Financial, and between 6 and 7 times forward earnings estimates. Of course, the big question for investors is, when will the analysts finally get it right? These names have been trading at similar discounts for years now. Shares of MetLife closed at $30.23 on Friday, declining 30% year to date. Based on a mean price target of $45.35 among analysts polled by FactSet, the shares have 50% upside. While the company is, of course, primarily a life insurer, it's considered a bank holding company because it holds MetLife N.A., which happens to be the nation's 10th largest mortgage loan servicer. MetLife is actively trying to sell the bank subsidiary, along with the mortgage business, in an attempt to escape Federal Reserve regulation as a bank holding company. The Fed in October rejected the company's capital plan, which would have included a dividend increase. The company hopes to pass the coming round of stress tests in January with flying colors. 16 out of 19 analysts covering MetLife rate the shares a buy. Next is Goldman Sachs, which closed at $90.10 on Friday, down 46% year to date. The shares have 51% upside based on consensus price target of $135.72. Analysts are expecting a very rough quarter for Goldman, but a decent 2012, with a consensus earnings estimate of $13.21. For Goldman Sachs and other investment banks, a lot is riding on the Federal Reserve's implementation of the Volcker Rule, which is part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law by President Obama last year. The Fed's 300-page draft Volcker proposal in October failed to define the short-term proprietary trading that they're trying to ban. The public comment period has just ended, so it's back to the drawing board for a critical new set of rules for Goldman and for other investment banks. Out of 21 analysts covering Goldman Sachs, 12 rate the shares a buy, 8 are neutral, and 1 recommends bailing on the shares. Morgan Stanley is next. The shares closed at $14.98 on Friday. The shares have 52% upside potential based on a consensus price target of $22.76. Analysts see the company posting a 15-cent loss in the fourth quarter after the company announced a settlement with bond insurer MBIA relating to lawsuits over commercial mortgage-backed securities. The consensus earnings estimate for 2012 is $2.06 a share. Out of 21 analysts covering Morgan Stanley, 12 rate the shares a buy, 7 have neutral ratings, and 2 analysts recommend selling the shares. Like it was for our national list, the New York bank with the most upside implied by consensus price targets is Citigroup. The shares closed at $26.03 on Friday for a year-to-date decline of 45%. Based on a consensus price target of $41.34, the shares have 59% upside. Analysts expect Citigroup to earn $4.35 in 2012. 15 out of 22 analysts covering the company rate the shares a buy, 5 have neutral ratings, and 2 recommend selling Citigroup shares.